India Business Insights. Here is the latest monthly economic update for September 2024. Stay tuned for the highlights and key developments shaping India's economy. GDP growth. First of all, let us look at the latest estimates and forecasts for the GDP growth. India's GDP growth has been robust, with both the IMF and the RBI projecting a 7% growth rate for FY 2024-2025. The growth forecasts from IMF has inched up from 6.8% forecast a few months earlier. This forecast has been supported by a broad-based recovery across sectors, particularly in rural consumption, services and infrastructures. Rural consumption has bounced back due to increased agricultural production following a strong monsoon season, which alleviated earlier concerns about drought. The improved showing of paddy, pulses and oilseeds is expected to result in a bumper harvest, boosting rural incomes and spending. The services sector, which contributes significantly to GDP, continues to expand, driven by sectors like IT, healthcare and financial services. The IT sector in particular remains a key driver of growth, benefiting from strong global demand for digital transformation services and cloud-based solutions. India's dominance in the IT outsourcing market has allowed its major IT companies to maintain high growth rates, contributing to both employment generation and foreign exchange earnings. On the infrastructure front, the government's focus on large-scale projects in transportation, renewable energy and urban development has played a crucial role in driving growth. Major infrastructure initiatives such as the National Infrastructure Pipeline, NIP and Smart City projects are expected to provide a significant boost to long-term economic growth. Moreover, the manufacturing sector supported by PLI schemes is expected to accelerate growth, especially in automobile, textile and consumer electronics. However, global uncertainties and geopolitical tensions remain potential risks to India's growth trajectory. Slowing demand from major export markets like Europe and North America could dampen export growth, while rising input costs in industries like manufacturing may impact profitability. Despite these risks, India's domestic consumption, supported by a young and growing middle class, is expected to remain a key driver of growth in the coming quarters. CPI, Consumer Price Index. The Consumer Price Index (CPI) for September 2024 increased to 3.65%, slightly higher than August's 3.60%. This rise, although modest, was primarily driven by a surge in food inflation, which remains a significant contributor to overall inflationary trends. Erratic monsoon patterns disrupted the production of key crops such as vegetables, pulses, and cereals, pushing their prices higher. With monsoons arriving late in many regions and rainfall patterns becoming unpredictable, agricultural output has suffered, particularly in rain-fed states like Madhya Pradesh and Bihar. These weather-related challenges have had a ripple effect on food prices, driving inflation upward. Despite these pressures, the inflation rate remains under control thanks to declining fuel prices. On the other hand, fuel inflation continued to drop as global crude oil prices has been moderate, even as the Indian basket price has gone up from $71.0 on 11 September to $75.22 at present, and domestic fuel tax rates remained unchanged. This downward trend in fuel prices provided much-needed relief to businesses and consumers, especially in sectors reliant on transportation. The decline in energy costs has also alleviated pressure on the cost of goods transportation, which indirectly reduces price pressures on other goods and services. However, analysts caution that situation remains fragile. Any shocks to global oil prices or prolonged disruptions in food supply chains could result in inflation exceeding the RBI's 4% target. The RBI's Monetary Policy Committee (MPC) has remained vigilant, focusing on striking a balance between maintaining inflation control and fostering economic growth. While inflation is currently under control, RBI Governor Shaktikanta Das reiterated the need to monitor food inflation closely, especially as weather-induced supply shocks could impact prices in the coming months. Food inflation, which has historically been volatile, is now more dependent on supply chain stability and the upcoming Rabi season. In the medium term, inflationary trends will likely depend on the success of the Rabi crop, which is highly sensitive to soil moisture levels and the availability of essential inputs like fertilizers. Government interventions such as subsidies for farmers and improved irrigation infrastructure could help mitigate inflationary pressures. Additionally, global factors like geopolitical tensions and commodity price volatility could still affect inflation trends, particularly in food and fuel. Foreign exchange reserves. India's foreign exchange reserves reached a historic high of $689.6 billion in mid-September 2024. This record level was bolstered by strong inflows of foreign direct investment, FDI, and portfolio investments across multiple sectors. India's rising attractiveness as a global investment destination has played a critical role in boosting these reserves. Sectors such as technology, renewable energy, manufacturing have seen significant foreign capital inflows, helping to drive up reserves. The consistent inflow of funds into these high-growth sectors indicates that international investors continue to see India as a promising market for long-term returns. The large foreign reserve cushion is critical in shielding India from external economic shocks such as currency volatility and geopolitical risks. With growing geopolitical uncertainties, including tensions in the Middle East and Eastern Europe, India's reserves provide essential protection against foreign exchange volatility. These reserves also allow the RBI to intervene in the foreign exchange markets if needed to stabilize the rupee during periods of high volatility. As the global economic outlook remains uncertain, India's large reserve pool is a key asset for managing its external vulnerabilities. Moreover, rising reserves have strengthened India's external position, improving its creditworthiness and making it easier for the country to borrow from international markets at favorable rates. The reserves also offer greater flexibility in managing India's external debt obligations. India's external debt stood at approximately $620 billion as of June 2024, and a high level of foreign exchange reserves ensures that the country can easily meet its debt obligations without putting pressure on the rupee or causing disruptions in the domestic economy. In addition to protecting the economy from external risks, India's foreign exchange reserves have also contributed to a stable exchange rate environment. The RBI has been proactive in using reserves to prevent excessive depreciation of the rupee, which helps maintain export competitiveness. The reserves have also helped India manage periods of capital outflows, ensuring that liquidity remains adequate within the financial system. Export-import. India's export performance in August 2024 remained strong, totaling $69.5 billion, an increase of 2.5% from July. This growth has primarily fueled by high demand for pharmaceuticals, electronics, and agricultural products in international markets. The pharmaceutical sector, particularly in the generic drug space, continues to be a key export contributor, with demand from developing countries and emerging markets on the rise. India's dominance in the production of affordable medicines, vaccines, and APIs, active pharmaceutical ingredients, has solidified its position as a reliable exporter. Similarly, India's electronics exports have gained momentum thanks to the Production-Linked Incentive (PLI) scheme, which has incentivized local productions of electronics components and semiconductors. The PLI scheme has encouraged major global companies to set up manufacturing units in India, increasing domestic production capacity. Additionally, India's agricultural exports continue to perform well, driven by strong demand for rice, spices, and processed foods from international markets facing supply constraints. However, India's imports surged to $77.5 billion in August, driven largely by large crude oil imports and increased demand for gold ahead of the festive season. The sharp rise in gold imports was tied to seasonal factors, including the upcoming festive season and traditional wedding-related purchases, which typically drive demand for precious metals. This rise in imports has led to a widening of the trade deficit, which stood at $8 billion for August 2024, up from $7.2 billion in July. Policymakers are closely monitoring the trade balance, as a persistent rise in the deficit could put pressure on the rupee and lead to capital outflows. However, the Indian government remains optimistic, with ongoing efforts to diversify its export base and reduce dependency on volatile imports like crude oil by increasing investments in renewable energy. Employment and labor market trends. India's employment landscape has been undergoing notable changes as the country continues to recover from pandemic-induced disruptions. As of September 2024, India's unemployment rate stood at 7.2%, reflecting a slight decrease compared to earlier months. The country has seen job growth in key sectors such as technology, manufacturing, and services, but challenges persist in informal sectors, which still employ a significant portion of the workforce. The agriculture sector, which had benefited from a strong monsoon season, saw a temporary rise in employment, particularly during the Kharif harvesting season. However, much of this employment is seasonal, and laborers often return to urban areas seeking jobs post-harvest. The technology sector remains one of the largest contributors to job creation in India, driven by global demand for IT services, cloud solutions, and digital transformation projects. The rise of startups and the growth of gig economy platforms such as Zomato, Swiggy, and Ola have also provided new employment opportunities, particularly for young professionals. However, informal employment, which constitutes a large portion of the labor market, has been slower to recover, particularly in sectors like construction, small-scale manufacturing, and textiles, where workers continue to face job instability and lower wages. Government initiatives such as Skill India and Make in India have been geared toward equipping workers with the necessary skills to transition to higher-paying formal jobs, especially in manufacturing and service-oriented sectors. The Mahatma Gandhi National Rural Employment Guarantee Act (MGNREGA) continues to play a vital role in providing rural employment, with demand for jobs under this scheme rising during the lean agricultural periods. However, structural issues remain, such as underemployment and the need for more high-quality jobs. Despite the government's efforts, youth unemployment remains a challenge. Young people, particularly graduates and first-time job seekers, continue to face difficulties in finding stable employment that matches their skills. To address this, policymakers are emphasizing the importance of vocational training and technical education, ensuring that workers are better aligned with the demands of India's growing industries. Banking and financial sector developments. India's banking and financial sector has shown continued resilience in September 2024, supported by stable credit growth and a healthy recovery in asset quality. Credit growth has accelerated, particularly in the retail lending space. A demand for home loans, automobile loans, and consumer durables financing has picked up. The Reserve Bank of India (RBI) has maintained a supportive stance, keeping interest rates stable to encourage borrowing and spur economic activity. This is particularly important for small and medium enterprises (SMEs), which are a significant part of the economy and have benefited from targeted financial support. The biggest challenge for the banks is the very slow growth in deposits in the banking system. The non-performing asset (NPA) ratio of banks has been declining steadily thanks to better asset management and an improving economy. As of March 2024, the gross non-performing assets (GNPA) ratio of scheduled commercial banks (SCBs) in India was 2.8%, a 12-year low. This is a significant improvement from the end of March 2023, when the ratio was 3.9%. The Reserve Bank of India (RBI) expects the ratio to improve further to 2.5% by March 2025. This improvement in asset quality is partly due to loan restructuring programs and the recovery of defaulted loans in industries like steel, telecom, and construction. Banks have also increased their capital adequacy ratios, ensuring a stronger buffer against potential financial shocks. The digital payment sector has continued to thrive, with platforms like Unified Payments Interface (UPI) seeing record transaction volumes in 2024. The rise in e-commerce, online services, and digital banking has driven the growth of fintech companies, many of which have entered into partnerships with traditional banks to offer a wider range of financial services. India's fintech revolution has made banking more accessible to millions, particularly in rural areas, where financial inclusion has been a key policy goal. In the capital markets, the stock market has shown resilience despite global uncertainties. The Sensex and Nifty indices recorded modest gains, supported by strong corporate earnings in sectors such as IT, pharmaceuticals, and renewable energy. Foreign institutional investors (FIIs) have continued to invest in Indian equities, seeing the market as a long-term growth opportunity despite geopolitical risk and inflationary pressures. The RBI has also expanded its focus on cryptocurrency regulations, aiming to ensure the stability of the financial system while encouraging innovation in the fintech space. Conclusion. These sections offer an expanded look at the key economic indicators for September 2024, providing a deeper understanding of India's economic resilience and potential challenges. September 2024 brought mixed signals for the Indian economy. While the RBI kept the repo rate unchanged in the last MPC meeting held in August 2024, most economic watchers are eagerly looking at the next MPC meeting to be held from October 7 to October 9, 2024 for an interest rate cut, particularly with a relatively benign inflation scenario. The broader economic outlook remains positive with strong GDP growth projections and robust infrastructure spending. Trade dynamics continue to be challenging, but the government's diversification efforts and domestic reforms are expected to help mitigate these risks. Stay tuned for the next month's update. In case you have not yet subscribed, please do so now. If you are already a subscriber, we would greatly appreciate it if you could leave a comment and like this video. Thank you. Take care.